here is a question that comes up at almost every dinner party, every family gathering, and every WhatsApp group that has one person who thinks they know about money. Should I buy property, or should I just invest in stocks? Now everyone in the room has an opinion. Your uncle swears by bricks and mortar. Your colleague just discovered index funds and will not stop talking about them. And somewhere in the middle you are sitting there wondering who is actually right. So today we are going to settle this properly. Not with opinions, not with YouTube thumbnails, and not with your uncle's story about the house he bought in the 90s. We are going to run the real numbers, the ones that include the things nobody puts in their pitch, the repairs, the stress, the time, the taxes, and what actually happens after 20 years. And by the end of this video, you will not just know which one performed better. You will know which one is right for you, and why that answer is different for every single person watching this. Now meet Jake and Claire. They are both 30 years old, they both live in the same city, and they both just saved up $50,000. Same age, same income, same starting point. But they are about to make two completely different decisions with that money. And those decisions are going to change the next 20 years of their lives in ways neither of them can fully see right now. So Jake decides to buy a rental property. He uses his $50,000 as a 20% down payment on a $250,000 house. He finds a tenant within 3 weeks, signs a mortgage, and feels, for the first time in his adult life, like a real investor. He tells everyone at work. He posts a photo of the keys on his phone. He genuinely believes he has cracked the code. Now Claire takes her $50,000 and quietly puts it into a total stock market index fund. No keys, no tenants, no mortgage. She sets up an automatic $300 monthly contribution and goes back to living her life. Her friends do not ask about her portfolio because there is nothing exciting to show them. But she is completely fine with that. Now here is the thing. Both of them believe they made the smarter choice. And for the next few years, it is honestly hard to tell who is right. But give it 20 years, and the answer becomes very clear. So for the first 3 years, Jake is winning the social proof game. He drives past his property and thinks, I own that. The tenant pays rent every month, the mortgage gets paid, and on paper Jake is making $470 a month in profit. Now let us do the napkin math the way most people do it. Over 3 years Jake collects about $64,000 in rent. His mortgage payments total around $48,000, so that looks like $16,000 in profit, right? Well, not exactly. See, what the napkin math leaves out is everything that actually costs money in real estate. Property taxes, insurance, a water heater that broke in year 2, a roof leak in year 3, and 1 month where the house sat completely empty while Jake kept paying the mortgage out of his own pocket. When you add all of that up, Jake's real take-home cash after 3 years is somewhere between $2,000 and $4,000 total. Not per month, not per year, total. And that is before counting the dozens of hours he spent answering calls, coordinating repairs, chasing paperwork, and driving across town on his lunch break to deal with things that needed to be handled immediately. Now, meanwhile, Claire feels like absolutely nothing is happening. Her $50,000 grew to $55,000 in year 1, then maybe $61,000 in year 2. It is just a number on a screen, and her friends could not care less about it. But at the end of year 3, with her $300 monthly contributions and a 10% average annual return, Claire is sitting on $76,000. And she has spent 0 hours managing it. 0 phone calls, 0 emergencies, 0 lunch breaks lost. Now, before we write off real estate completely, we have to talk about the one thing that keeps Jake very much in this race. And that one thing is leverage. See, when Claire put in $50,000, she bought $50,000 worth of stocks. That is a straight 1-to-1 exchange. But when Jake put in $50,000, he took control of a $250,000 asset. The bank covered the other $200,000, and that changes everything. So when that house goes up in value by just 3%, that 3% is not calculated on Jake's $50,000. It is calculated on the full $250,000. That is a $7,500 gain on a $50,000 investment, which is actually a 15% return on his money. Now by year 3, even with the slow cash flow, Jake's equity in that property has grown to somewhere between $55,000 and $65,000. And he built that using the bank's money, not his own. This is the single most powerful argument for real estate, and it is the reason property has created more millionaires than almost any other path in history. When it works because you are playing with a much bigger number than you actually put in. But here is the other side of that argument. Leverage makes the wins bigger, and it makes the problems heavier too. The bank does not care if your tenants stopped paying. The mortgage is still due on the 1st of every month. Now, if you are seriously thinking about going down Jake's path, there are 4 costs that almost nobody mentions when they are selling you on the landlord dream. And not knowing these 4 things is exactly how people end up losing money in real estate while believing they are making it. The first one is vacancy. The average rental property sits empty for about 1 month every single year. That is 1 full mortgage payment coming out of your own pocket with 0 income coming in to cover it. The second one is maintenance. You should be budgeting between 1% and 2% of your property's value every year just for ongoing repairs. On a $250,000 house, that is between $2,500 and $5,000 annually, and that is in a year where nothing major goes wrong. The third one is what property investors call capital expenditure. The big-ticket items that are not a matter of if but when. Roofs, furnaces, plumbing, water heaters. These things will eventually need replacing, and they come in chunks of $5,000 to $15,000 at a time. If you are not setting money aside for these every month, you are not a real estate investor. You are just lucky for now. And the fourth one is the bad tenant. And every landlord eventually meets one. A tenant who stops paying rent can take 3 to 6 months to legally remove from your property in many places. And that one situation alone can wipe out an entire year of profit in a single event. Now, Claire does not deal with any of these 4 things. But she has her own version of a problem, and it is called volatility. In a bad month, Claire might open her app and see her account down 30%. That feels terrible. And most people panic and sell at exactly the wrong moment, which is honestly the only way you actually lock in a loss in the stock market. So now let us jump forward to year 20. Because this is where the math stops being theoretical and starts being genuinely surprising. Here is where Jake ends up. His property is now worth somewhere between $450,000 and $500,000 depending on the market. His mortgage is nearly paid off. And after 20 years of fixing toilets, chasing rent checks, dealing with renovations, and managing the 4 costs we just talked about, his total cash flow profit over the entire 20 years is somewhere around $40,000 to $80,000. Now his total net worth from this one property, including the equity, is roughly $500,000. And that is a genuinely impressive number. There is no argument there. But now let us look at Claire. With a 10% average annual return and her $300 monthly contributions that she never stopped, Claire's boring index fund has grown to somewhere between $420,000 and $460,000. Now here is where it gets interesting. They are in almost the same place financially after 20 years. But the way they got there is completely different. Jake worked a part-time job for 20 years to get to $500,000. He had stress, he had debt, his money was locked inside one house in one neighborhood, and he could not touch it without selling the whole thing. Claire waited for 20 years and let compound interest do the work. She has full liquidity, meaning she can access her money in seconds if she needs it. She never lost a night of sleep over a broken pipe. And if she had simply added $200 more per month to her contributions, her portfolio would have hit $600,000, beating Jake without a single extra hour of effort. So who won? Honestly, the answer depends entirely on what you value more: the size of the final number or the quality of the 20 years it took to get there. So here is the honest answer to the question everyone came here for. Real estate wins if you treat it like a proper business from day one. If you learn the numbers before you buy, if you price your rent correctly, if you budget for the 4 costs we talked about, and if you are genuinely willing to put in the time that property management requires, you can build serious wealth through real estate and do it faster than almost any other path. But if you go into real estate thinking it is passive income, if you buy based on a YouTube video or your uncle's advice, if you underestimate the costs and overestimate the returns, then you are not investing in real estate, you are buying yourself a second job that you did not fully interview for. Now, stocks win if what you value most is freedom and simplicity. If you want your money growing without it taking up space in your head, if you want the ability to access your money quickly when life happens, and if you are willing to sit through the uncomfortable months when the market drops and not panic sell, then a simple index fund strategy will build genuine wealth over time with almost none of the complexity that real estate requires. And here is the part that most comparison videos skip entirely. You do not have to choose only one. The most financially stable people are usually doing some version of both, building equity through property while also letting the market compound in the background. The question is not which one is better. The question is which one fits your life, your time, your temperament, and your actual financial situation right now. Now, before you close this video and go argue about it in the comments, there is one thing I want you to take away from everything we just covered. The real trap is not choosing real estate over stocks, or stocks over real estate. The real trap is making a $50,000 decision based on a headline, a thumbnail, or something somebody said at a family dinner. See, both Jake and Claire built real wealth, but they built it by making a deliberate choice that matched their actual life. Jake knew he was willing to put in the work. Claire knew she wanted simplicity, and both of them ran their own numbers before they committed. So here is what I want you to do before you make any decision about where your money goes. Sit down with a piece of paper and ask yourself 2 honest questions. First, am I looking for a new challenge to manage, or am I looking for my money to grow while I sleep? And second, if I include everything, the time, the taxes, the repairs, the stress, the opportunity cost, does this investment still make sense? Because the answer that includes everything, that is the only answer that matters. Now run your own numbers. Take your time with this decision. And if this video helped you think about it more clearly, share it with someone who is sitting at the same fork in the road right now, because the best financial decision is always an informed one.